Hey guys, this is Mobashi, and today we are going to analyze Max Care Healthcare or Max Healthcare Institute. So basically, we are going to analyze its fundamentals and technicals too. Let's start with its technicals, right? So Max Health Care Institute Limited. Okay. So as we can see, it is. Let's go with the one-day chart. Okay. I think weekly chart will be the best. Okay. As we can see, the chart of the Max Healthcare Institute Limited, it is continuously going up. As the fluctuation is too much, as we can see that it is quite too much. Not look like it is not. We can do rupee cost averaging here. Okay, and now it has broken. It is support which it was taking, and it is quite concern because I think this is come from the Donald Trump 100% tariff on the patented pharmaceutical products. It is not quite directly connected with that, but still it is a healthcare related thing. So yes, it is connected with that. Okay, so the IPO was launched not exactly, but approx 17th August 2020, and within from that duration, it has made it is around 10x. If you have invested 1 lakh, it will become around 10 lakhs, right? And now it is down by the around 18% from its all-time high. So we can say it is a good opportunity, but it has broken its previous support. So it is quite concerning, and we can do rupee cost averaging here. We can buy some of the units, but before that we have to analyze it is fundamentals too. So let's start with that. Max Healthcare history. Okay. So let's start with what was the main business of that of this company. Max Healthcare Institute Limited is a primary engaged in the providing healthcare services through the primary care clinics, multi-specialty hospital, medical centers, and super specialty hospitals providing the operations and management, medical services, clinical radiology, pathology services, and related healthcare services. So basically, they are in the business of providing healthcare services. As the name suggests, they are doing the same business. Services offering Max Healthcare, hospitals network. They have a 22 healthcare facility with the 5,000 beds. Okay. Operation matrix. Okay. So there is a bad adding schedule. They are for the half to financial 2025. They are uh, planning to add 408 for the rest 1044 crores, and afterwards, as you can see, they are continuously going to do capex for that. Okay. So as we can see that the company's market cap is 1 lakh, around 1 lakh crore. So basically it is a large cap company. Stock is 86, and industry is 58, so it is quite overvalued. We have to see the PAG ratio first. As we can see, the PAG ratio is more than 1, and it is even 3.84. That shows that according to its growth, the P is not justified. Okay, let's see. Let's go with more in depth. Return on capital employed is 14, around 15%. Return on equity is 12.7. So that shows that the company is having a debt. As you can say, debt to equity is 0.32. So it is quite low, and debt is quite acceptable. Interest coverage rate is only 9, approx 9. EPS growth for the 5 years 45%. That's great. Quick ratio is more than less than 1, and the current ratio is also less than 1. That shows that the company's short-term liquidity is not good. That is also concerning. Book value is 96. Consider this as 100, and current price is 1069, around 11 times. Okay, price to book value is 11 times, and the industry price to book value is 7 times. So it is quite overvalued here too. Change in promoter holding is 20 approx 27%, and the current promoter holding is only 23.7%. It is a major concern. It is a very major concern. We have to look at that. Okay, sales growth for the 5 years 30.1%. That's great, and the EPS growth for the 5 years also great. Okay, and the EBITDA is also too much high. Okay, dividend is only 0.14. That's not good. So let's analyze the it is P along with the EPS trend. So in Jan 21 they were having a P of 91 along with the EPS of 1.78, and the Jan 22 they were having a P of 83 and the EPS of around 4.8, and the Jan 23 they were having a P of 46 and the EPS was 9.74. It was the best time I think to buy that stock as per the EPS and P trend. And the Jan 24 they were having a P of 72 and the EPS of 10. That's good. And in the Jan of 25 they were having a P of around 105 and the EPS of 11 approx. And now they are having a P of 86 around and the EPS of 12. That's quite as per the EPS and the PE trend, we can say the company is quite undervalued, as the company is always in the overvaluation. So I think as per the observation with the all the ratios, the company is not doing well. So let's quickly compare with its peers. So quarterly sales variance good. EPS for the PEG for the company is not good. EPS for the 12 months, if we compare with that, is also not good. So sales variance for the 5 years good. Profit variance is also good. Interest coverage is quite acceptable. Current market price to the book value comparing with the industry is good. EBITDA is quite high. Current market price to sales is also high. ROE or an ROE also ROC is also not good. Pledge, there is no pledge. Debt to equity is quite good. P also too much high. So let's quickly analyze it is quarterly results. Sales variance, year on year sales growth, as we can see, it is continuously going in positive. From June 22 they were having a 1000 crore of sales. Now they are having 2000 crores of sales. It is quite 2x within 3 years of time span. And expenses, material cost looks like the materials and employee cost is the major concern for the company, and company is not efficiently able to reduce the material cost. Also, yes, company is efficiently able to reduce the employee cost. So I think it has impacted the operating profit margin. As we can see, the operating profit margin has been increased from 25 to 26. That's good. Other income, okay, that's not playing a major part here. Interest obligation is quite low if you compare with the sales, and the overall profit from 173 to 300. Company is able to generate approx 130% more profit within 3 years of time span. That's good. Now analyze the profit and loss statement, that is income statement. From 2017 to 2025, within the span of 8 years, the company is able to from 1600 to 7000. That's huge. I mean, just look at this number. Around we can say 5 times. Company is able to generate 5 times more sales as compared to March 2020. That's very great, I can say. Material cost, company is efficiently able to reduce the material cost. Manufacturing cost has been increasing over this, maybe because of the patents and all, I think. Employee cost, as we already saw that the company is efficiently able to reduce this cost too, which has impacted the operating profit margin. It's been increasing over this. I think it can increase more, because if they are efficiently able to reduce the manufacturing cost, which will lead to the increase in the operating profit margin too, right? Interest obligation is quite fluctuating, and but I think they are not the major concern here. And net profit from 1600 to 1000 crores. Look at that. Look at this number. I mean, look at this number. That's very great. I mean, that's very good. So balance sheet, let's quickly analyze it. Is balance sheet equity capital. Look like company is continuously diluting their shares. As we already saw that the company is currently only having promoter only having around 23.7% of holding, and they have sold within 3 years around 27%. That's very big concern. We have to watch that. Okay. So reserves, as we can see, the company is doing very great with the reserves borrowings. So company is having a long-term borrowings measure. This has to be reduced, and the short-term borrowings too. Okay, lease liability is not a major concern. Fixed assets. Okay, look like companies continuously purchasing fixed assets like land, building, plant, and machinery and all. That's very good for the company. Capital work in progress also be so they are like 901 crores. That's very good. Investment company is not doing that much investment. That's not a major concern. But still, overall the balance sheet looks quite strong. Now look at the cash flows. How much actually cash is going, coming and going. Okay. 1200. Let's compare with the profit and loss. So let's 1500 and 100. Sorry, 26, 28. Within 3 years, the company is able to generate around 2800 crores. Let's compare with the profit and loss. 28 crores. Here it is 28, right? So it is around 27, 28. Okay, that's it. So look like company is doing very well. They are not doing sales on credit. They are also collecting the cash. That's very good sign for the company, right? So receivables are not that much. I mean, as you can see, it is they are increasing, but that's not major concern. Inventory is very less. Payables are quite acceptable. They are look like they are doing one-time payment, right? Okay. Cash from investing activities, where the company is investing, like as I told you that they are actually investing for the fixed assets and all. Interest received, look like they have fixed deposits. Okay. Cash from the financing activities, from where the company is getting the money. Look, they have sold their shares here. As you can see, they are continuously diluting their shares here. Proceeds from the borrowings, they are they are taking long-term borrowings. Okay. Interest obligation, dividend, so very less share, very less revenue. Okay. Ratios. Debtor days is reducing over there. That's very good. Inventory days is quite increasing. Okay. Days payable is quite high. That's a very good sign. So overall, the cash conversion cycle becomes in negative. That shows that the company's net working capital is isn't tied up in the business. Net working capital is in terms of like total current assets minus current liabilities divided by the sales into 365. So companies don't have to hold companies capital doesn't tied up in the business for a long period, right? Even they don't have to hold their cash. They are look like they are doing business with the help of their suppliers. Okay. Shareholding pattern. As we already saw that the majority recently company has sold within 3 years, they have sold major of their shares. That is around 28%, right? Here it is 27%. Sorry for that. That's where the major concern for the company. That's not good for any company. Major FIs holding the major stake in the company. As we can see, there was a time they were holding around 60%, and now recently they have reduced some of their shares in the company. DIs initially holding too much shares in the company, but now they have initially reduced their shares, but again they start buying in the company, right? And public looks like public don't have that much interest in the company. So basically the major players are here are FIIs. So overall, if let's see the any origination happening here. So announcement under the regulation 13, change in the management, changing the senior manager and personal director. So it is a very big concern that the director is resigning, and also on the Feb announcement under regulation 13, changing the management, change the senior management personnel. That is also not good. And announcement under regulation 13, resignation of director, original details with respect to the resignation of the Mr. Harmeen Mehta. That's also not good. Look like there are too many important person, key managerial person are leaving the company. So overall the company is doing very well, but the valuation are not supporting the company's financials. Okay, and also this resignation and the promoters holding are also creating the major concern. So I think uh, it is better to avoid this stock. Even thought it has a very good potential, but still it is overvalued. Also there is a promoter's concern also there, so it is better to avoid this stock. Thanks for watching. Have a nice day.